Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Thank you for giving us a few minutes of your time here, deep into August as we head into Labor Day. You can see a few topics. What we're going to talk about this week, we're going to talk about oil and gas and really some of the longer-term views on that sector and why we remain bullish, at least in part. Federal Reserve activity and financial conditions. It's been a very active Fed period. You could say that just about at any period, but it's just been hyper so with meetings and then followed up by their release of their notes and so on. So we'll drill into that a little bit, talk about inflation consensus, and then lastly, some underlying components of inflation. So Andrew's going to take you on a deep dive to inflation, which of course feeds right back into the Fed and how they're viewing it. So we'll kick off and talk about oil and gas. Right here, we do have crude oil at the top and natural gas at the bottom. The blue line represents the prices for each of those commodities. And then the orange is the domestic rig count. So think of it in terms of how much supply that the United States producers are producing. I'll draw your attention on crude oil particularly. I think this is crucial to understanding the environment that we're in. And look at their behavior from 2011 to 2014. I say look at their behavior as if it was bad or irrational. No, they simply got very bullish on their capabilities. Some of them were newfound fracking and horizontal drilling, and they really began to build out capacity here in the United States. And they really outdid themselves ahead of what became an oil crash in 2014 and 15. That nearly wiped out a good chunk of our domestic producers. And that really changed the way that they approached business. And you can see that in today. So if you look at from 2021 on, and the price of oil has really rebounded strongly, they have been very slow to react. I believe this stems very strongly from their experience of being nearly wiped out during the last run. So they're being very disciplined, and no matter how far oil runs up, they're not going to overchase it or get ahead of themselves. And that feeds back in a positive way. There's a lot more to oil and gas, but that is one of the factors feeding into a very positive supply-demand dynamic. And we can see a very similar thing in terms of natural gas. Of course, one of the main reasons we remain bullish on the natural gas has to do with Europe and their situation, something Andrew has hit many times throughout the year, and that remains as bullish today as it has been throughout then. So energy and energy stocks remain a significant piece of our portfolio, especially compared to the S&P 500. Just wanted to share a couple of those reasons why. I turn over to the Fed and financial conditions. So again, the Fed has gone back and forth. Their primary message, I mean, you can kind of cut through the noise. I believe they have been about as clear as they could be. If everybody could do better in their messaging, but they've been pretty clear that they're going to tighten things. They are going to have interest rates go up, and their number one objective is to be as forceful as they need to be to bring inflation down. That's their sole goal. One thing that we have seen over the past several weeks are financial conditions. So the Federal Reserve's policy has been to tighten things up. And if you look at the blue chart, what it shows you is it's going from a negative territory, which are tightening conditions, going back up into zero and close to where we would say they are loosening. So in many ways, if you want to simplify this, the market has been working to undo. And this goes for stocks advancing. This goes for credit conditions and interest rates coming down on riskier borrowers, a whole host of things. The market has been working to undo some of the Federal Reserve's reaction. So this feeds back into our opinion that as of now, our belief is that what will shine through is that they're going to continue to be aggressive, in no small part to this. They've got to see financial conditions get tight and stay tight, or else we'll just never have a chance of getting core underlying inflation under control. And speaking of inflation, Andrew, I thought this was a really important way that you shared this with us on Monday, because we could have a variety of expectations. And Howard Marks always put this well. Really what matters is if you're going to outperform, you have to be somewhat different than the crowd. And so you really helped give us insight into where that crowd is on inflation.
Yeah, so the chart we're going to look at here is looking at from Bank of America, and they do a survey of different fund managers, different mutual fund managers specifically. And they ask them a series of different questions regarding their portfolios. Are they bullish? Are they bearish? How are they positioned? Is there certain parts of the market that they're overweight or underweight? What do they think the biggest risks are to the market? A whole host of different questions. And they publish this once a month to kind of give insights from how are institutional level investors, fund managers, how are they thinking about the stock market? And it's really interesting when it comes to inflation. The sentiment towards inflation is very much everyone's kind of on one side of the equation here. What we're looking at specifically on this chart is that dark blue line. This is the net percent of people that responded to the survey questions that expect that global CPI, global inflation, will be coming lower. What they asked them is how many think it's going to be higher, and basically no one said that they do. The general consensus, the heavy consensus, was very much that inflation has peaked and will come immediately back down. We look at many different gauges of this. We can look at the market expectation, a lot of other surveys of economists and fund managers. And across the board, we're seeing that it's almost a large assumption that inflation is going to come right back down to the Fed's 2% target in just a matter of months, or at least by next year. And then the result of that will be the Fed will be able to cut interest rates, and this whole process of raising rates will be finished. And that's kind of what the base case is right now. And so we don't really have to argue, are they right, are they wrong? It's more to understand where is the crowd positioned right now. And then we know, look, as we go forward, if the data begins to confirm that, we can expect how they'll change or adjust their portfolios. And more importantly, if the crowd is proven wrong, and let's say inflation data does stay a little bit more elevated, maybe comes down a little bit, but we don't get right back to 2%, as it seems that many believe, then we know they're probably going to have to start shifting their portfolios. And then we can start within our own team trying to analyze where's the shift's going to happen, what's going to be the benefactors of that, and then what will be maybe the parts of the market that will weaken or be harmed by the fact that this expectation was proven wrong. But right now, the general consensus is that inflation is going to come right back down. We're a little bit more hesitant if we were surveyed in this question, and don't think it's going to be a straight line down. That maybe inflation could stay elevated for a little bit. A lot of the data that doesn't change as fast as maybe the energy markets do, it's still staying fairly elevated. And so we think it's going to be a little bit of a rougher road and won't just be an immediate drop to 2%, as it seems the markets has a big expectation of.
Yeah, very well said. And I guess another spin on that is, even if it were, and even if inflation does come right back down to normal, there's no essential way to profit off of that. If you buy those, the right mix of bonds that gear themselves towards lower rates of inflation, the market has already priced that in for you. There's no way to gain an advantage on that. But right. Sticking with the inflation, want to take a look at the underlying components, because I thought this was very important. So if you walk us through the various feds, regional feds, and their measures here.
So when you give a group of nerdy people a lot of data, they're going to be able to give you a lot of different looks and different variations of that. And inflation data in the Fed is no exception to that. So we often see the big numbers that get reported in the news, or the CPI, the Consumer Price Index. That's the most popular, most commonly discussed gauge of inflation. On the nightly news, that's the one they're probably going to talk about. But the Fed by no means has that as their only tool or observation on how inflation is operating. We have each of the different Fed branches, you could so to speak, Dallas, Atlanta, and Cleveland, each take all that inflation data. There's actually 178 inputs that go into how they measure inflation. And they each put their own little spin on it to try to look at, to kind of pull out a lot of the noise, a lot of the pieces of data that are really jumpy. Think of, again, commodity prices, things that can move quite a bit, and look at what is the kind of the sticky, what they call the sticky inflation gauges, the things that are much slower moving. Examples of that would be children's apparel, recreation, medical care supplies, alcohol costs. A lot of these things do see price changes, but they're not as volatile as the price of maybe gasoline, or actually the price of shelter and things like that. And so these different gauges are looking at the slower moving components of inflation, and what they're showing us and what this chart shows, you can see they're still going higher. Well, a lot of the gauges of inflation have started to crest and started to potentially roll over. Some of the slower moving components of inflation still are rising. And this is what gives us pause that maybe we have seen maybe the actual peak in inflation, but we don't think it's going to be an immediate collapse because we still see a lot of the slower moving components still haven't started to slow down their rise just yet. And then the other point I would attach to this is looking internationally. We're still seeing a lot of heavy inflation internationally, specifically in Europe. Germany's still having a major inflation problem, as are many other European countries. And so that's the fact that they're having continuously expansion inflation could seep its way back into the US. And so we think that this conversation of inflation has been around all year, and we think it's probably going to be something we're talking about, unfortunately, for a little while longer before we really can get back to that traditional 2-3% inflation. Actually, the prior 10 years, even less than 2% inflation. We don't feel like the inflation topic's done just yet, unfortunately, but it's something we're privy to, and we're going to continue to monitor and watch closely, and especially how it's going to impact the portfolios.
Excellent. As always, appreciate that, and appreciate all of you for giving us your time. As always, just a couple of reminders. Give us a call if you haven't seen us, come in for an update, or if you're concerned about things and want to have a repeat appointment, give us a call, 800-928-4001. Scan the QR code. Take it conveniently to set that up. And also don't forget our weekly radio show live over the airwaves on WIBC Saturday mornings, or however you get your podcasts. So thank you again and have a great weekend.